Welcome back, everybody. We just had one of the most wild weeks for the stock market after the FOMC meeting Wednesday, where Jerome Powell came out probably the most dovish that he's ever been since the beginning of quantitative tightening, starting in March of last year. So we seeing a change in tone from the Fed? We'll talk about that later, but we also had a jobs report that came in so high that it looked like a typo. And finally, we're going to be reviewing some earnings and looking into this week's earnings and also looking at the data that's coming out this week. But we're going to start out with a recap. So to recap this week, we had Powell come out and speak on Wednesday at 2 p.m. after the Fed decided to raise rates by 25 basis points. And this was to be expected. We've been watching the Fed futures, and we know that the Fed has become complacent in doing whatever the markets tell them. So they did the 25 basis point rate hike, down from a 50 basis point rate hike the month prior, and then down from 75 basis point rate hike the month before that. So we're seeing a decrease in the speed of interest rate hikes, which was to be expected. But what we didn't expect was the tone that Jerome Powell gave. And that was a dovish tone. Jerome Powell actually left pausing raising interest rates next month on the table. So there's a chance that we might not even see any interest rate hikes next month. And there's also a chance that we could be cutting rates by the end of the year, starting in November, and then also cutting rates in December, according to the Fed futures. So the bond market is expecting the Fed to capitulate and start to decrease interest rates towards the tail end of this year. But Fed Chair Powell is still pitching the soft landing, and, well, I think that's a fantasy. I don't think that you can get inflation out of the picture without going into a recession, but maybe, very small chance, the Fed can engineer this. He did say, though, that we are still seeing inflation in parts of the economy, such as services and in housing and rents, and he said that is likely to continue for the next few months, and he wants to see that come down. And in order to bring inflation down in those parts of the economy, they're going to have to keep raising rates. So is he going to decide to just put that out of the picture, or are they going to do what they said they will and bring inflation back to 2%? It's really a balance between raising interest rates and cooling off inflation versus the labor market. That's the dual mandate for the Fed. And in the labor market, we are seeing it coming in red hot according to the latest jobs report. In the last jobs report, this came in at 517,000 jobs added versus just 185,000 expected, and this is up from 260,000 the month before. So this is almost double what we saw last month, which is really concerning because whenever it comes to the labor market, this ends up dictating what people get paid. If there's more jobs that are available, then people will get paid higher wages because they can negotiate back and forth and find new jobs. And that ends up trickling down to goods inflation because there's more money in the system buying the same amount of goods. So if you have $100 to spend on 100 apples, then each apple is $1. Whereas if there's $200 now to spend on 100 apples, now those apples are worth $200. Simple economics, supply and demand. But this jobs report came in so high that it looked like it wasn't even real. It looked like it was a typo. Somebody might have mistaked a 2 for a 5. So I'm wondering if this might be revised in the future or if this is the actual number. And if it is the actual number, then the Fed definitely has a concern with wage inflation and they need to continue to raise interest rates. And if they do continue to raise interest rates in order to cool off the labor market, then we're going to see a lot of pain to come in growth in tech names, which have been doing somewhat okay in their earnings. So let's go over earnings from last week. Last week we had AMD coming in at 69-cent earnings per share versus 67 is what Wall Street was expecting. But this was on a non-GAAP figure, which accounts for stock buybacks and it accounts for employee stock compensation. But if you exclude those things from their earnings per share, they actually came in at just 1 cent earnings per share. So they barely skated by on profits, and they got a lot of their profits from employee stock compensation and buying back shares of their company. And this is a common theme throughout the growth names, where they made so much money over the last few years to where they can use this as leverage in order to give Wall Street whatever earnings per share they want to see. And that's exactly what we saw with the name AMD. Now, Apple actually ended up missing their earnings per share, even after making so much money in the last few years, where they came in at 188 cent earnings per share versus 193 expected. And I'm curious if this was due to the shutdown that they saw over in China, where they had to close down their factory because of COVID. That would have led to lower production and inevitably lower sales. And another interesting piece on the earnings is their services revenue, which is how much they make on the App Store, was another record. Not surprised there, because we are seeing record inflation for services, but it did actually end up missing Wall Street estimates, and this is one of the first times that this has ever happened. So I'm curious if this is going to start to slow down as people are more and more against the 30% tax that the IMOB is charging. Personally, I'm developing an app and I'm not looking to put it on the App Store because I don't want to pay that 30% tax on top of the tax that I'm already paying to our government. And then finally, we had Amazon coming out with our earnings, which was a huge disappointment, coming in at just 3 cent earnings per share, so barely profitable versus a 15 cent earnings per share, what was expected. And they only expect to do $4 billion in net income for 2023. So if this is the case with a $1 trillion company, this means that they're trading at a 250 forward price to earnings. And in a tightening economy, this is not what you want to see. This is a huge drop in their earnings, which is really unexpected from these big tech names, but it is probably inevitable because they've been doing so well over the last 3-5 years. And now they're finally starting to see that the higher interest rates means that they can't grow their company as quickly. And in other companies, we're going to see shrinkage in earnings. So that's the earnings that came out last week. But for this week, we have a few big names. I'm going to start out with PayPal. Their earnings per share is expected to come in at 122 versus 87 last quarter and 92 a year ago. And if we're looking at historical, they come in at an average of 94 cent earnings per share. So they're expected to do 30% better in their earnings per share while doing about 20% better in their revenue, which means that they're expected to continue to increase their margins, which I'm not really sure if that's going to be the case, but the revenue is expected to come in at $7.39 billion versus 6.85 the quarter before and 6.18 a year ago. And historically, they've done $6.45 billion in revenue over the last 8 quarters. So they're expected to keep raising the revenue quarter after quarter and year over year. And I wouldn't be too surprised with this because, again, the high services inflation means that they can make more and more money, but it is questionable that they can increase their margins because of the rising dollar. It's going to cost them more money in order to exchange currencies, but we'll have to see. Next up, we have Uber, which is expected to come in at negative 21 cent earnings per share versus negative 61 cents the quarter before and negative 128 a year ago. But this is extremely volatile, so you can't really base Uber earnings on past earnings. I would base it more so on historical data. And their historical earnings per share over the last 2 years has been negative 44 cents. So they're expected to reduce their losses by roughly 50%. And then for their revenue, they're expected to come in at $8.46 billion versus $8.34 billion last quarter and 4.8 a year ago. So they're definitely increasing their revenue, no doubt about it, based on their revenue history at $5.48 billion. And again, this quarter is expected at $8.46 billion. And this is one of those companies that is actually free cash flow positive. And I was kind of shocked. The CFO for this company is actually managing their balance sheet somewhat well. And they also have $8.6 billion left in cash. And on top of the free cash flow, this might be somewhat of a decent opportunity for the long term. And finally, the last earnings that we have for this week is going to be Disney, which is expected to come in at 80-cent earnings per share versus 30 cents a quarter ago and 106 a year ago. And if we're looking at historical, they've done 72-cent earnings per share over the last 8 quarters. The revenue is expected to come in at $23.3 billion versus $20.15 billion last quarter and $21.82 billion a year ago. And if we're looking at historical data, they've done $18.76 billion in revenue on average for the last 2 years. So based on historical data, they're expected to do 25 cents worse in their earnings per share and 17% worse in their revenue. So they're expected to do worse in earnings and slightly less worse in revenue. So their margins are expected to start decreasing, which is interesting considering that Disney Plus, I feel like, is making up more and more of their earnings, which is a software business, which is usually more margin friendly. So that's all the earnings that are coming out for this week. And in terms of economic data and events, we have Powell coming out and speaking again at 12:40 on Tuesday. And I'm wondering, will he hose the markets off after he set them ablaze on Wednesday? Or is he just going to let it be and let the markets rally? We'll have to see. But we have other Fed talks this week. We have Fed Barr coming out on Tuesday and Wednesday. We have William and Waller both coming out on Wednesday. And then we have Fed Harker coming out on Friday. And it's really all about the vibe that these Fed members give. Is it dovish or is it hawkish? Now, Barr is the third most dovish member, so they're expected to probably come in dovish. Williams is a moderate hawk, so their comments are probably going to be the most important out of these few. And then Waller is the second most hawkish member of the Fed, so their comments are almost definitely going to be hawkish, especially with the hot stock market that we're experiencing. And in terms of data this week, it's going to be a pretty boring week. We have consumer credit coming in on Tuesday at 3 p.m., which is expected to add $24 billion in consumer credit. With the higher interest rates that we're experiencing, this means that consumers won't have as much money to spend throughout the economy. We also have a 10-year treasury auction. I know, snooze. But this is going to affect the 10-year treasury rate, whether people are willing to buy up the auction or not. That will determine if bonds go higher or lower, and this has an inverse correlation with the rate. So if the 10-year bond goes up, that means that the rates are going to come down. And then if the 10-year rate goes down, that means that the bonds are going to be going up in price. And this will have a direct impact with the stock market. Whenever rates go up, tech stocks usually come down. Whenever rates go down, tech stocks usually go up. And then after we have the 10-year treasury auction, we are going to have the jobless claims. After the report last week, this is definitely going to be an interesting watch. This coming in on Thursday at 8:30 in the morning. This is expected to come in at 194,000 versus 183,000 the week prior. And I think this is probably going to come in to expectations or maybe higher because people just can't afford to be unemployed anymore. And we're seeing a trend where more people are taking on a second job. And I feel like more than 5% of our working population have more than one job. Maybe I'm wrong here, but I think this is an underestimate. Next up, we have the Michigan Economic Report, which has been losing its weight over the last couple of months, but this is coming in at 10 a.m. on Friday, where the inflation expectations are expected at 2.9% on a 5-year horizon. So consumers expect inflation to stay at 3% almost for the next 5 years. For the next 1 year, they're expecting 3.9% inflation, so they don't think that the Fed is doing its job in reducing prices. The sentiment is expected to come in at 64.9 versus 64.9 the month prior. So no change expected here, but the consumer expectations is actually expected to rise just a little bit at 62.9 versus 62.7 the month prior. The analysts think that the consumer is assuming that the economy is going to do better over the next 1 year, but I don't know about that. I feel like the economy is almost certainly going to go into a recession, but based on what the Fed is saying, they are expecting some marginal economic growth towards the end of this year. So we might be seeing what's known as stagflation, where you have high inflation, which is what the consumers are expecting, and the economy can still be kind of putting along. We'll see slow growth, but we'll still see growth, and we're still going to see the high inflation. That's what the consumer expects, at least. Now, in terms of technical analysis, we have 4 stocks I want to look at: SPY and the earnings plays for this week. So if we check the SPY chart, we're expected to be in a range of $404 to $420 by the end of this week. And we have some supports at $410.79, $406.60, $403.10, and then $399. And for resistance, we have $418.21, which is a Fibonacci retracement, and then we have $421.22, which is slightly outside of the expected range for this week. So we'll see if we can get out of that range. We're going to need something pretty major in order to do that, though. And if we're looking at RSI here, it's currently trading at 63, so you could consider it overbought, which means that it might be more sensitive to bad news if that does come out this week. But otherwise, this is looking bullish since it's still above 50. I don't usually like to look at overbought or oversold. I just like to look at if it's above 50 or if it's below 50, and that'll tell me if the stock is bullish or bearish and if it changes sentiment. For PayPal this week, we're expected to be in a range of $77.50 to $83.50. The supports are going to be at $83.11, $81.46, $78.40, and $75.43. And then we have resistance at $88.25, $90.67, and $97.27. And right now we're trading at 66 on the RSI. So a miss on earnings per share or revenue could send this plunging below 80, but a beat or a meet on their earnings per share might end up carrying this above 83. Next, we have Uber, which is expected to be in a range of $29.50 to $36.50 by the end of this week. We have supports at $31.85, $30.96, $29.57. Then we have resistance at $34, $35.57, and $37.50. We have a super hot RSI at 74, and this is the highest stock on a 52-week basis. And I think we're likely to see a revenue beat just because of the high services inflation. This is a service after all, transporting people. But if they end up missing on their revenue, then this could end up in Uber stock falling below 30. But if they end up beating or meeting on the revenue estimates, then I think this could probably hold 31. And finally, the last stock is Disney. The expected range is 103 to 118. The supports are at 108.85, 105.99, 103.45, and 99.38. There's resistance at 112.67, 117.33, and 112.21. And right now it's trading at 69 RSI, so another overbought stock. A miss on earnings per share could send this plunging below $106, but a meet or a beat on the earnings per share and the revenue could probably prop this above 108. But obviously, this is all my expectations. I could be totally wrong, but we'll have to see. What do we have in store for this week? Let me know your thoughts on these few stocks down in the comments below. What are your expectations for their earnings? Thanks for making all the way to the end of this video. And as always, remember to stay positive, stay green. I'll catch you in the next one. Bye, guys.